this ETF could be especially beneficial in these very extreme times. First off, read this disclaimer carefully. This is the ETF for today. It's the Direction Flight to Safety Strategy ETF, the FLYT. The reason why this one is very interesting, that's because of what is happening now in global markets, here reflected with the S&P 500, okay? This is the S&P 500 and we are now entering a huge battleground, okay? There is very good reason to expect increased volatility going forward. We are now battling the 100 and the 200 day moving averages. On top of that we also have the 3000 level on the SPX. And there's very good reason to think that this is going to be a very dicey time going forward. We are in a very strange market because we've had the longest bull market in history after, the housing bubble, on the S&P 500 at least. It bears mentioning that many stock markets around the world are not even close to recovering from the housing bubble, the 2008 financial crisis. Hence, there is something very problematic about, the major bull market kind of being exclusive to a few countries, because if, as is the case, you have a few companies lifting the market and a lot of decay underneath, you don't really have a strong bull market. Anyway, we have seen a lot of money at least flee to the USA. The S&P 500 has been rising, the longest bull market in history, and now we've had a huge crash, which some people are now arguing is going to be the shortest bear market in history. That doesn't make a lot of sense, and given that there's this extreme uncertainty, this completely unparalleled situation, there is some possibility that we could rally to new all-time highs. But if we do that, it would be a completely unparalleled situation, and unparalleled situations will spook the markets. Hence, it's not actually bullish that we were to go to new all-time highs. Then again, which many people also think that this is basically a bounce within the bear market, then that is also the argument to have some flight to safety. Meaning, if you think that the market is going up, or if you think the market is going down, in both instances, it could be a good idea to look at an ETF like this, the FLYT. Direction Flight to Safety Strategy ETF. So this is an actively managed, multi-asset fund that aims for total returns. It has a portfolio of multiple assets that have defensive exposures during market downturns. It includes a volatility-weighted basket of gold, US-listed large-cap utility stocks, and US long-term treasury bonds with maturities greater than 20 years. These are like classic defensive plays. The interesting thing is that if you look at the recent move, so when the market has been going up, you can see that this one also had some rally. Meaning it is not like it is not like a pure bear market ETF. It is total return. The fund overweights assets with the lowest trading volatility in 5 years with an additional 22.5% cap on its gold component. They may also invest in ETFs, swap contracts, and investment companies to obtain exposure to certain securities or commodities, meaning they have a relatively flexible range of options, which is good. So let's now do some analysis here, some technicals. Let's get the FLYT up here. For some reason, I was not able to find the FLYT on investing.com, hence we had to go to stock charts. Okay, so here you can see the trend analysis. We do not have a lot of data for FLYT because it recently hit the market. You can, however, see that it is relatively close to these two key moving averages, which is the exponential 20-day moving average and the 50-day moving average. It basically is shuffling a bit sideways here. Let's do some other analysis. Let's look at, I think this could actually be quite interesting. Here we are seeing the relative strength of FLYT versus the S&P 500, the mid caps and the small caps. And you can see here that during the period of between February and leading up here into to March 24th, you can see that the FLYT was stronger than the S&P 500 and you know, the mid caps and the small caps. After that, it has weakened a bit, but you can see here that during these more turbulent times, the FLYT was outperforming the S&P. So that's interesting. That's some very interesting data. There's evidence that it actually can perform during the more rocky times. Let's do some volume analysis just quickly. We do not get a bunch of data, but it's not a huge surprise that this is where the big volume zone is. Let's look at the money flow. Zoom in here. During this time when we have been shuffling sideways, we have seen some, some reduced money flow, but that is not a huge surprise, because when there are these sideways movements, there quickly becomes, buying fatigue, because there's not really something happening. But the fatigue is not that dramatic. Here is some momentum analysis. Here you can see, the Bollinger Bands. We are now testing, the 20-point moving average on the Bollinger Bands, and you can see here that the PPO, there's been some improvements here. Not ready to send a buy signal yet, but there's something going on here of interest. But all in all, we do not have a lot of data, but the data we do have, it certainly suggests that the FLYT is able to a reasonable extent perform as it is intended to, meaning during rocky times it is supposed to give you some safety. Here is some performance data. Performance is year to date is 3%. Let's go here. You can see that the expense ratio is actually pretty decent, 0.40%. Given that this is a actively managed and very specialized ETF, this is a very low expense ratio actually. Let's see if we get some other data. It is rather limited. Average daily dollar volume, 537,000 US dollars. That's not too bad. I mean, this is a relatively newcomer to the market. Let's now have a segment about bear markets and how they rhyme. Because history, it doesn't repeat, but it tends to rhyme. Okay, so these are the lessons so far based on previous bear markets. It is very important to carefully read charts and heed warnings. Technical indicators are, however, self-fulfilling. This is one of the reasons why it is very prudent to use the technical indicators that are used by most people, because if you are using some esoteric indicator that you maybe even made yourself, you might get all kinds of buy and sell signals that other people are not getting. This is one of the reasons why I started the video by looking at some of the key moving averages, because these are the moving averages and price levels that tons of people are watching right here, right now, and that will increase the volatility and the reliability of those moving averages and indicators. It is extremely important to let the trend be your friend. This is something I say in every video, and it is one of the most important phrases in the entire market. It is very easy to get stuck in the ideas you have. This is one of the reasons why I explicitly say that I am a normative bear, meaning I think we should have a bear market, we are due a bear market. But when something is normative, it is something that you think should happen. It doesn't mean you think it is happening. That's the key difference between a normative and the descriptive statement. Very important distinction. Because the market can be wrong and mispriced way longer than you can stay correct and liquid. And the market can be absolutely crazy. There's tons of examples of that. The very interesting thing is that there are big moves in safe havens before the shit hits the fan, okay? We did see a rally in the government bonds and in precious metals, and quite some time before the major crash in the stock markets. And it is very interesting to see that bonds and gold in particular, it's remained strong even during this recovery in the stock market. Meaning, if you have a balanced portfolio of some stocks, some commodities, bonds, you name it, then you could be able to profit by having a combination of essentially kind of bearish positions and also bullish positions. Meaning you would benefit from being market neutral, and that would be extremely beneficial, of course, if we do see that this bounce we've had actually is a bounce and then we have a continued bear market. That is to be determined, and that is also why this week and the coming weeks are going to be super important for the stock, for the future of the entire world economy, basically. Because this is the decision point, bear or bull. The bear markets, they start when things are peak good and end when things are peak bad. That's another key lesson. There are always bull and bear markets out there. So look at different countries, look at different asset classes. There's always some bull market out there and some bear markets. And that is why you always can be market neutral. Doesn't matter whether you have the strongest bull market or the strongest bear. Market neutrality is like the golden road of investing, because it does one of the best things, and that is removing the dread of market moves. You can rest, safely. During a bear market in particular, do not catch falling knives until after they hit the floor. When you see a falling knife, it can be very prudent to have it on your radar, because when a falling knife stops falling, you can see those extreme moves, percentage-wise. Even though it is still very far away from the highs, the way percentages work is that if you do have a 50% pullback, it needs to go up 100% to get back to even, which is why market timing is very beneficial. The things that, when you look at previous bear markets, the size of the bear is definitively contingent on the size of the prior bull. This is why it is a very high probability that the current recovery in the stock market is a bear market rally. Simply because the bull market we had before the current bear, it was really long. It was the longest bull market in history. It doesn't make any sense that the longest bull market would be followed by the shortest bear. That would be absurd. If something like that were to happen, then that would actually be kind of more it would create higher risk of volatility than by just having a full-on bear market, because volatility is a function of the market's ability to expect and predict future movements. Everyone is now expecting, well, a lot of people are expecting now that we are going to have a decent bear market. If we do get a full recovery, it will just break all kinds of financial models. It will just shred apart everything we know about financial markets. It will be a completely new paradigm, and that is not something that the market likes. The market likes predictability. Okay, so yeah, it will be super volatile. Hence, it is very important to be as market neutral as possible going forward. Bear market rallies, they tend to be violent. Hence, you could make a strong case that the rally we have seen, it is very similar to previous bear market rallies. Bears hedge against rallies like bulls hedge against corrections. Dow theory still matters, and you need to look at whether the Dow average and DJ corroborate each other. Always focus on the big picture. History shows that politicians and media tend to downplay bear markets, and this is of course out of self-interest. In the USA now we are entering into an election cycle, and there's a very strong connection between the health of the stock market and the probability that the president will be re-elected. Hence, Trump is going to be willing to do anything possible to prop up the markets. Anything. And the Federal Reserve, it's going to be... It's harder for the Federal Reserve to then just be completely neutral. Because the Fed does not want to be caught in some, huge political battle. Which increases the probability that the Fed is going to be accommodating, which we have seen so far. The big problem with the accommodative nature of the Fed is that the Fed's tools is actually limited, and we currently have a situation in which the market is doing anything it can to manipulate the Fed into becoming more accommodative. But if the Fed uses up too much of the tools too early, then that is another risk factor. Volatility spikes prove markets' inability to efficiently price in risk factors. One of the myths out there is that the market is so efficient at the pricing. I think that is basically bogus. If the market was that efficient at pricing in the future, looking far out, then we would never have the volatility spikes. And the recent volatility spike we had was just extreme. Interdependence between countries and asset types due to globalization and tech. This makes diversification much more complicated than it used to be, which is why it is prudent to be as diversified as possible. Because back in the day you could diversify between different sectors and then call yourself a diversified investor, but that doesn't hold it nowadays. You need to just be fully diversified between different asset classes, have some long, some short, just a real mix. Governments, they have definitively increasingly intervened in the markets, and this is something we have seen. That is the major trend. The market has become more and more nationalized, and something that happened now after the recent crisis is that we have seen an absolutely shocking level of nationalization and also centralization. The big companies out there have become even bigger. Look at companies like Amazon, look at other digital players especially. They have gone from being strong to super strong. And the fewer big companies you have, the more lobbying power they are going to have, and effectively the closer relationship you're going to have between private businesses and the government. Because one of the dirty secrets of private enterprise is that they are not really these free market private companies. They have a very close and intimate relationship with politicians. That is actually one of the key reasons why they can be that strong. Yeah, it's a huge topic, but it's something to think about, because many people have this illusion in their head about there being some big difference between the private businesses and the government and the public sector. That simply is not the reality. It is more a question about the size of the organization. Big organizations, they work with each other because they have self-interest. They do all big organizations, they want to keep the disruptive small challengers outside. That is the entire business model. If the only relationship they want to have with these small challengers is to acquire them. That's what they want. They do not want competition. Yeah. Whatever you do, of course, you want to let the trend be your friend. Extremely critical times in the market. Be very careful, and there will be fireworks.